So Chad, what did we learn from this quarter as these companies reported? Is there anything new here? Was it worse than expected, better? It seemed like the market was kind of neutral on it. We didn't get a lot of big swings.
Sure. Thanks, Oliver. Yeah, for the fourth quarter, we've seen earnings from about 4 or 5 of the companies in the space. And the results were pretty similar across the board. I mean, look, in North America, occupancies were right around 40-ish%. So that's down from, pre-pandemic levels of 70%. And RevPAR, revenue per available room, was down about 50. So across the board, Hilton, Hyatt, Marriott, Choice, just depending on their mix and chain scale, they were slightly better, slightly worse. But I think the important thing that companies uniformly have talked about is maybe a slightly better group business coming out of this in the back half of 21 and 2022. And also the big unknown is business travel. So people like myself getting back on the road with their roller bags rolling into offices here, they've actually seen some pretty encouraging signs and have had some good conversations. So I think that's probably the one thing that is still the unknown from a leisure standpoint. And leisure is about 40% of your rooms. Leisure is going to be strong. No one can deny that. The household income spend, will increase as we come out of this. It's really just that business travel, and that's where we've seen some green shoots.
So, Chad, right now, the sectors of the market that were the most hit, the kind of ground zero for this crisis, has obviously been hotels, airlines, cruise lines. We saw that for the cruises and the airlines, some of these companies had to do a little work to the balance sheet. They had to find ways to shore up their finances. What about for some of the major hotels? I mean, largely we're talking Hilton, Hyatt, Marriott as some of the most actively traded ones here. Those are the ones I'm mostly interested in. I mean, are there changes to balance sheets, or should we be largely thinking about these as the companies that they were pre-crisis?
By and large, these companies have done a great job over the last couple of years. I mean, they've really strived to have investment grade debt, and they've done a good job just keeping low debt on the balance sheet. Hilton talked about, I think their average maturity is 7 years out. Their average cost of capital is down to 3.3%. So, prior to this, it was all about cash burn. How many months of liquidity do you have on the balance sheet? Most of these companies that you talked about have somewhere between, I'd say, 18 and 24 months. So I think they'll be fine. And remember, for the most part, they're just ticket takers. When the properties open back up, they get their fees. The business model of a franchisee or a managed property, they get roughly 10% of the revenues that their partners earn. So it starts to come in pretty quickly. And then from a capital allocation standpoint, I think the money that they bring in will just go back to paying down debt. Historically, they've done a great job buying back stock and increasing those dividends. But not much cash is needed in this business. They're not really the developers, which is great.
We're looking at your take on Marriott right now, neutral rating on the company, about $100 price target, a little bit below. What's it going to take for you to be more optimistic on these? I mean, it looks like chart-wise, I don't know how much technicals play a role, but all these companies are like on the verge, it seems, of a breakout if they can do it. Actually, in fact, the PMI manufacturing that showed the services component up this morning seems to maybe be working. These stocks are all up today as we speak. Number just came out above expectations for services. So, Chad, what do you want to see to really be optimistic that these make a good trade right now? It sounds like you think they're fine companies, but maybe not the best investment yet.
Yeah, look, I think, COVID to date, the stocks are roughly flat. These brands, Hilton, Hyatt, Marriott, the companies that own the assets, the hotel REITs, they're still down about 10 to 15%. So clearly some of the recovery trajectory is priced in here. What we've done in the past and what we're doing now is comparing them to other franchisee models in the restaurant industry and the fitness industry, again, kind of the ticket takers. And it looks like that valuation gap has compressed versus some of those other peers. So what we need to figure out is this going to be viewed as a better asset class for investors, given how quickly it can rebound and given that, people want to get back out on the road. But yeah, we have neutrals across the board, which has been, I guess, the right call on an annual basis. But certainly this recovery trade is something that people really like. On the recovery trade, the ones where we have buy ratings, MGM Resorts, so more of a derivative play on the Las Vegas recovery, and then Playa, PLYA, which is a Caribbean destination play. But yeah, neutrals across the boards right now.
Okay.